Perhaps you've noticed this interesting trend in recent years. While you are giving away a part of your income through taxes, the biggest US and global corporations are not. And if they are, these taxes are so small that they are basically a joke. But what you might not know is that it wasn't always like this. American corporations used to pay much higher taxes than individuals, but for some reason, this has changed completely, and without most people ever noticing. This is an explanation of what happened, how, and why. The untold story of how US corporations stopped paying taxes. Explained. So usually when we talk about corporations, we talk about the corporate tax rate that defines how much taxes should corporations be paying. In the 1950s, this tax used to be more than 50%, but since then, it slowly started going down to 40% under Reagan, even lower under Clinton, and then finally to 21% under Trump. This tax rate is usually what's at the center of attention, and it's what you hear about in the media and politics. But that's not what this video is about, because the official corporate tax rate is not the main reason why corporations pay so little taxes, and it actually matters far less than we think. The thing is that the official rate and how much corporations are really paying are two very different things. This graph shows what the US corporate tax rate was over the years, but it doesn't actually show how much the corporations really paid. That is measured by something called the effective tax rate, which says how much taxes corporations actually pay. And that paints a whole different picture. At one point back in the 1950s, the official and effective tax rates were the same, meaning that companies did really pay as much as was the official rate. But then the effective tax rate started going down way earlier and faster than the official one. And while today the official corporate tax is at 21%, the effective tax rate is way below 10%. That kind of makes fighting over the official tax rate not as important, since no one is paying that anyway. And it suggests that the real issue is probably somewhere else. Now you might be asking, how is that possible? How come that corporations pay so much less than they should be paying? Well, the answer to that are tax loopholes. They are the real reason why corporations often pay almost no taxes. And they are one of the most important tools of corporate America that allows the largest companies to pay zero taxes and save billions of dollars by gaming the system in a completely legal way. And yet, this is almost never talked about. But before I explain how it works, I want to talk to you about the sponsor of this video, Morning Brew. I don't know how you consume information, but I have a tendency to spend way too much time on Twitter or Instagram, just mindlessly scrolling without actually learning anything new, especially in the mornings when I wake up. And so for the past few months, I've been actually subscribed to Morning Brew, and I can honestly say that it is actually a really good way to get the latest news about finance, business, and tech. Morning Brew is a daily newsletter that's completely free, and it gives you the news in a very understandable and easy to read way, which is especially nice because a lot of the traditional business media can be pretty dry and full of jargon. To give an example, from the recent issues of Morning Brew, I found out about the leak of the Grand Theft Auto new game, and I have been able to follow the bizarre case of the Luna founder Do Kwon and his disappearance. So if you're interested in business, tech, or finance, there's no reason not to subscribe to Morning Brew. It takes less than 15 seconds and it's completely free, so click the link in the description and start using Morning Brew as well. And now back to the video. But what are these loopholes and how do they work? Well, let me introduce you to the US tax code. A list of all the rules, exceptions, exclusions, deductions, regulations, and everything else that defines how the tax system works. The complete compilation, which is apparently necessary to understand the tax code in full, has close to 70,000 pages. That's roughly 17 times more than all the books in the entire Harry Potter series combined. And the code is amended so often that on average it changes once a day. And somewhere in this incredibly complicated document are hundreds of exceptions that allow corporations to legally avoid taxes. And while it's almost impossible to pinpoint all of them, there are three main methods that corporations use. The first one is using tax credits. Basically, these are a tool for the government to encourage a certain kind of behavior by allowing you to deduct expenses spent in a certain way from the taxes you have to pay, like the research and development tax credit. This one was created in 1981 during the Cold War because the US government was worried that it's failing behind the USSR in its ability to innovate. And so the R&D tax credit was meant to encourage US companies to spend more on research of new technologies by letting them deduct the cost of this research from their taxes. Now, in theory, this makes sense, but in reality, not so much. Because nowadays, the R&D credits are used so widely that they don't actually encourage anything. Corporations often claim credit for research that they would have done anyway, or that has questionable value for anyone apart from the company itself, like designing new flavors for soda drinks. And so the way this tax break is used has nothing to do with the original intentions behind it. And the same thing applies to other types of tax credits as well. Large corporations employ armies of lobbyists that influence what tax breaks in each industry will be, and they do so in a way that makes it as favorable for those companies as possible. And only a fraction of tax credits end up actually helping the original goal, whether it's innovation, protection of the environment, or anything else. The second method is called the stock options loophole, and this one is particularly interesting because it explains why corporate executives are paid so much. You might have heard about it. Executives of publicly traded companies often get absolutely insane compensations, like the CEO of Roblox, who was paid over $230 million in 2021, the CEO of Warner Brothers, who made close to $250 million, or the CEO of The Trade Desk, who made an insane $830 million in 2021 alone, 2/3 of his company's entire revenue for that year. But there is a reason why executives are paid so much, and it's not because they would be so good at their job. The thing is that these ginormous compensations are paid almost entirely in stock options, meaning that the executives are given millions of shares of their company. Unlike paying them in cash, this doesn't actually cost the company anything. But because of the stock options loophole, the company can deduct their compensation from their taxes as if it paid them real cash. And so it is actually profitable for them to pay their CEOs as much as possible, because the more shares they give away, the less taxes they have to pay. And finally, the third method is known as offshoring. Basically, US corporations have to pay very little or no taxes on profits that they technically make abroad. But since profits can be moved on paper from one country to another regardless of where they were actually made, this opens a load of possibilities for very creative accounting. Basically, this rule gives corporations an incentive to shift their profits to tax havens, like the Bahamas, where the corporate tax is 0%, declare them as a foreign profit, and pay no taxes on it in the US. But this is just the beginning, because offshoring can get a lot more creative. In one documented case, Whirlpool, the home appliances company, made profit in Mexico through its Mexican branch, and it should have paid both Mexican and US taxes from it. But the Mexican branch was owned by a Mexican shell company with no employees, that was then owned by another shell company in Luxembourg. And Whirlpool claimed that since all three countries have different tax rules, it can't pay taxes in any of them. And all of this was completely legal. In the end, the company was forced to pay taxes in the US, but only because it went too far with it, and claimed that Whirlpool had substantial operations in Luxembourg, when it only had a shell company with one part-time employee. Now, you might say that what these corporations do is entirely legal, and you would be right. But while it is legal, it is not really fair, specifically for two reasons. First, because of how these loopholes happen. The term loophole suggests that they are a product of an unintentional omission, a mistake made by the policymakers and left in the tax code by error. But that's not actually true. Most of these loopholes were put in there intentionally, through lobbyists working for the same companies that benefit from them. And in that way, they are not loopholes, but rather intentional rules written specifically to benefit individual companies. And second, even though some of these loopholes could be technically used by anyone, they require incredibly complicated tax and accounting operations that are impossible to manage for anyone but the biggest corporations, that employ entire departments dedicated to figuring out how to pay as little taxes as possible. What that means is that only the biggest corporations are able to game the system in this way. They are the ones who actually influence what the rules are, and they are the only ones who can take full advantage of them. In that way, they are skewing the playing field, which should be equal for everyone, and allow some to play by completely different rules than most. And it doesn't seem like any of that is about to change.